Welcome to the PAI Morning Briefing. I'm your host from Pantheon AI, and today is March 17th, 2025. Good morning, everyone. I hope you're settling into your day with a hot cup of coffee or tea, ready to dig into the latest market insights and economic trends that might just spark your next brilliant move. Let's kick things off with a quick market overview to set the stage.
Overnight, the major indices posted modest gains. The S&P 500 closed at roughly 5,656, up by about 0.36%. Meanwhile, the Dow Jones Industrial Average advanced to approximately 41,685, a rise of around 0.54%. The tech-heavy Nasdaq managed a slight increase too, finishing near 17,733, up a very modest 0.1%. In the small-cap space, the Russell 2000 saw an uptick as well, finishing around 2,050, with an increase in the neighborhood of 0.4%.
On the digital currency front, Bitcoin continues its steady ascent, trading at nearly $83,268, with an increase close to 0.84%. Ethereum, not to be left behind in the current crypto rally, stood near $1,910, posting an uptick of roughly 1.24%. These figures might seem small at first glance, but in the world of markets, every fraction counts, and these modest advances can set the tone for the day ahead.
Now let's dive deeper into some of the major market trends that have been capturing our attention lately. There's plenty to talk about as we consider both the microdynamics of individual sectors and the broader macroeconomic narratives at play. One of the headline stories that has dominated conversation in recent weeks revolves around the Federal Reserve's decision-making process regarding interest rates. Economists widely expect that the Fed will hold its benchmark rate steady at its meeting this week. Despite the calm on surface, there's a palpable undercurrent of caution, as the Fed apparently adopts a wait-and-see posture while the long-term implications of certain political and fiscal policies come into focus.
Yes, you heard that correctly. While the rates remain unchanged now, there are growing murmurs regarding so-called bad news cuts that might materialize in the fall. Essentially, the market seems to be betting that if the economic data turns downwards, or if external shocks start hitting consumer sentiment, the Fed might have no other option but to slash rates to stave off a slowdown. And if you've ever tried to pin down the unpredictable nature of economic policy, you understand why this ambiguity keeps investors on their toes. It's like being on a roller coaster. You know you're in for some twists and turns, but you're unsure just when the next dip will come.
Adding another layer to the narrative, we've seen notable volatility in investors' sentiment, as measured by what many in the market refer to as the fear gauge, the VIX index. Recently, the fear gauge spiked and then slid rather quickly, causing a mix of relief and renewed caution among market participants. The VIX's behavior is keeping everyone on edge because while a temporary surge might be interpreted as a bullish sign, a sort of buy the dip scenario for some, the underlying volatility also carries the risk of jolting investors out of positions at exactly the wrong time. It reminds me of that old adage, if you're not scared, you're probably not paying attention, and in these uncertain times, paying attention is more critical than ever.
Moving on, we've got another exciting piece of news coming from the world of corporate leadership. At Intel, there's been a significant shakeup with a new chief executive now at the helm. Lip-Bu Tan, the recently appointed CEO, is making headlines by putting his money where his mouth is, literally. He is set to purchase about $25 million in stock shortly after assuming control. This isn't just a symbolic gesture, it's a strong message to the markets and to board members that he has skin in the game. Investors tend to appreciate when a leader has such a direct financial commitment to the company's performance. This bold move by Mr. Tan adds an extra layer of credibility to his strategic blueprint for Intel, suggesting that he's not just an outsider parachuting in with ideas, but someone whose personal fortunes are now inextricably linked with the company's fate.
Let's now pivot to another narrative that has been buzzing around lately, the evolution of the streaming wars. In a competitive landscape dominated by numerous digital content platforms, Netflix has emerged as a frontrunner. Analyst firm MoffettNathanson has recently raised its price target for Netflix amid growing optimism about the company's advertising model, which promises not only huge upside potential but also sustained profit margin growth. It seems that after years of intense competition and strategic realignments, Netflix might have finally found a winning formula, leaving competitors to wonder, if Netflix has truly won the streaming wars, where do the other players go next? This question could very well set the stage for some dramatic shifts in media consumption patterns in the coming months.
Now, taking a step back, I'd like to touch on a few additional pieces of news that round out the broader market picture. First, let's circle back to the Federal Reserve's stance. Despite market chatter appearing in multiple headlines, the reiteration of the Fed's stand-pat approach is noteworthy. The repeated message underscores a critical point. The Fed is deliberately walking a fine line between caution and action, waiting for more concrete signs from economic data before making any radical moves. This measured approach, while frustrating to traders on the hunt for volatility, reflects the institution's commitment to ensuring that any policy shifts are grounded in tangible changes in the broader economy. So when the Fed finally makes a move, be it a rate cut or an unexpected hike, we might be looking at a significant turning point for all asset classes, from stocks and bonds to cryptocurrencies.
In addition, the chatter around the market's monthly swings, particularly that VIX spike, brings up the timeless question. How do you prepare for volatility when it seems almost inevitable? It's an excellent moment for investors to ponder risk management strategies. High volatility can present opportunities for those with a steady hand and a long-term perspective. Yet it can also be a snap in the face for those who let short-term fears drive decisions. This delicate balance between risk and reward is at the heart of every investment decision, and the current environment leaves little room for complacency.
Let's spend a bit more time discussing Intel's recent leadership move. When a new CEO not only steps in but immediately signals his alignment with the company's future by investing a significant sum of personal funds, it serves as a tangible vote of confidence. $25 million is not chump change. It's an unequivocal signal to stakeholders that Mr. Tan's vision for Intel is backed by his personal commitment. For investors in the technology sector, such moves can also act as a bellwether for broader trends. When leadership changes are coupled with strategic insider investments, they often suggest an impending recalibration of company strategy, whether that involves ramping up research and development, pivoting into new markets, or simply repositioning to combat long-standing challenges. Of course, there is always an inherent risk. Sometimes such moves are too little, too late, or they might be a gamble on untested strategies.
But if history is any guide, markets tend to reward bold bets made by CEOs who put their own money on the line.
Now, as we move into our detailed sector analysis, let's take a closer look at some of the key industries that are getting a lot of attention right now. In the technology sector, which is arguably at the heart of so many dynamic shifts in the market, the stories surrounding Netflix and Intel are particularly illuminating. Netflix, having emerged as a champion of the streaming wars, is now showing potential for sustainable growth thanks to its innovative advertising model. In an era where traditional television is giving way to digital platforms, Netflix isn't just sitting back, it's actively reinventing its revenue streams. The raised price target by analyst firm MoffettNathanson indicates that there is robust investor confidence in the company's ability to not only capture market share, but also enhance profit margins.
It's a thrilling time for the sector because these kinds of innovations might well serve as a template for other players trying to navigate the turbulent waters of a digital-first world.
Meanwhile, back in the heartland of semiconductor and computing innovation, Intel's strategic hire and subsequent insider investment by its new CEO signal an optimistic outlook for the company. The move is seen as a vote of confidence, potentially heralding a new era of expansion and possibly even groundbreaking product releases in the near future. For those keeping a close eye on technology stocks, these developments not only spark excitement about Intel's prospects, but also lend insight into broader trends in chip manufacturing, artificial intelligence integration, and even emerging fields like quantum computing. It's as if the industries that power our digital age are preparing for a renaissance, where bold leadership and strategic investments align to potentially shift market paradigms.
Switching gears slightly, let's talk about the finance and energy sectors, which also hold their own unique narratives at this moment. In the financial sphere, much of the chatter centers around the Fed's cautious approach. The delay in aggressively adjusting interest rates might be good news for banks, which often thrive on a stable environment with predictable borrowing costs. However, there's an underlying current of uncertainty as markets look ahead to potential rate cuts if the economy shows signs of faltering. This cautious stance by the Fed is a reminder that even when things seem stable on the surface, macroeconomic undercurrents remain complex. It makes you wonder, how long can the economy sustain this delicate balance before pressures force a more dramatic intervention? Investors in the finance industry might be asking themselves this very question while recalibrating forecasts and risk assessments.
Moving on to the energy sectors, while it might not always be front-page news like technology or finance, energy remains a fundamental driver of global economic activity. Recent trends in renewable energy, shifting policies, and fluctuating fossil fuel prices continue to exert influence not only on energy companies themselves but also on the broader market. With economic uncertainty looming and geopolitical factors adding layers of complexity, companies in the energy space are having to navigate a landscape that's as challenging as it is dynamic. For instance, fluctuations in oil prices can often have a ripple effect across other sectors. Think transportation, manufacturing, and even consumer spending. In a world where sustainability battles traditional energy sources, it's fascinating to watch how market forces and policy changes are gradually converging to potentially reshape one of the oldest industries on the block.
What about global markets implications? Well, nothing in today's interconnected economy happens in a vacuum. The Fed's stance on interest rates, for example, doesn't just affect American investments, it reaches across the Atlantic and into emerging markets, influencing capital flows, exchange rates, and even policy decisions in far-off financial districts. Investors around the world are closely monitoring these developments, and smart money is always on the lookout for subtle shifts in monetary policy that could signal larger changes down the line. Similarly, the dynamics in the technology sector, from the streaming wars to semiconductor leadership, have ramifications not just for Wall Street, but also for major economic centers in Asia, Europe, and beyond. Global supply chains, trade relationships, and international competition are all part of the broad canvas that all these individual stories help to complete.
Now, let's inject a bit of that signature humor into our conversation. Sometimes it feels like navigating these markets is like trying to solve a complex jigsaw puzzle while riding a unicycle. Challenging, unpredictable, and a little bit nerve-wracking. I often joke that if I had $1 for every time someone said it's unpredictable out there, I'd have enough money to invest, or at least join a circus. But hey, in the midst of all this volatility, a little levity goes a long way. After all, if you can't smile at the state of things, then what can you do? It's all about maintaining perspective, whether you're a seasoned trader or a newcomer learning the ropes.
Speaking of learning, let's shift now to expert insights and predictions for the near future. Given the current mix of cautious central bank policy, moderate gains in key indices, and transformative moves in the tech sector, I would say that investors are at a crossroads. The question on everyone's mind remains, how long can we maintain stability before a major turning point forces a reevaluation of strategies? The Fed's hesitant approach is like that calm before a storm, or as calm as it can be before a possible hurricane of rate cuts if the economic outlook takes a nosedive. Meanwhile, tech leaders are making bold moves, indicating that innovation and risk-taking continue to be the driving forces behind market optimism. So what does this mean for you, our listeners? It means that vigilance is critical, diversification remains key, and sometimes a contrarian perspective can yield surprising opportunities.
Let's take a moment and consider some thought-provoking questions. What will be the long-term impact of the Fed's wait-and-see approach on sectors like finance, lending, and real estate? Will the anticipated bad news cuts actually pave the way for a rebound, or might they instead signal deeper structural issues that we've yet to fully grasp? And as we watch tech giants like Netflix push boundaries with new revenue models, will traditional media companies be forced to reinvent themselves, or will they fall by the wayside? These are the kinds of queries that keep market analysts up at night and fuel the dynamic debates you hear at boardrooms and trading floors across the globe.
Diving a little further into our sector analysis, let's talk about technology again, since it remains arguably the most dynamic force in the market right now. Netflix's ascent in the streaming wars is more than just a win for the company. It's a sign that consumer tastes are evolving at breakneck speed. As traditional advertising gives way to sophisticated digital strategies, and as consumer data becomes a treasure trove for targeted campaigns, the entire landscape of media and entertainment is undergoing a radical transformation. One of the most exciting aspects of this is how technology is enabling more personalized viewing experiences. It's not just about binge-watching your favorite series, it's about smart algorithms that anticipate what you'll love next. This puts Netflix in a unique position, with an advantage that competitors can only hope to match. However, with opportunity comes risk.
The technology sector can be notoriously fickle, and even giants with strong fundamentals can face sudden headwinds if innovation stalls or if consumer preferences shift unexpectedly.
Now turning our gaze to the finance sector once again, the Fed's policy decisions have an almost magnetic pull on this space. With interest rates poised to remain steady for now, banks and financial institutions are enjoying a relatively stable environment for lending and investment. However, the potential of a sharp policy shift later in the year means that risk managers and portfolio strategists need to prepare for a diversified range of scenarios. What if the bad news cuts come sooner than expected? Would this lead to a surge in refinancing, or might it trigger an overextension in credit markets? These are questions that continue to crop up in financial institutions' risk assessments. It's a delicate dance between optimism and caution, and the key, as always, is flexibility and preparedness for varied outcomes.
Let's not leave out the energy sector here either. While it might seem a bit toned down compared to the vibrancy of tech or the intricacy of finance, energy remains one of the most critical pillars of the global economy. The interplay between fossil fuels and renewable sources is creating a fascinating dynamic, where legacy systems are being challenged by innovative, sustainable alternatives. For investors, this means keeping an eye on policy changes, international agreements on climate change, and technological breakthroughs in energy efficiency and storage. In many ways, the trends in energy are a microcosm of broader societal shifts, a gradual but unmistakable move towards sustainability that will likely redefine industry norms for decades to come.
Looking at the global market implications, it is clear that these domestic developments have significant international ripple effects. The Fed's policy decisions, for instance, influence everything from emerging market debt to the way global investors position their portfolios. Similarly, breakthroughs in technology, whether in streaming, semiconductors, or renewable energy, affect global supply chains and competitive dynamics across continents. This interconnectedness means that even small changes in U.S. monetary policy can cause ripples in market as far afield as Asia or Europe. For investors with global exposure, it's a reminder that staying informed is not just a necessity, but a key part of long-term success.
As we draw these threads together, a couple of expert insights come to mind. First, the notion that a period of apparent calm can suddenly give way to unexpected turbulence is a recurring theme in market history. Those who remember the narrative prior to past economic shifts may not be surprised by the current cautious stance of the Fed, or the mixed yet hopeful signals from the equity markets and technology sectors. And if history is any guide, then staying agile in one's investment approach will be the best way to manage the uncertainties that lie ahead.
Second, the strategies deployed by leaders in the tech space, like Lip-Bu Tan's decisive action at Intel or Netflix's reinvention of its revenue streams, are indicative of the broader trend where leadership and policy decisions are increasingly intertwined with market performance. When CEOs invest personally, it's not simply about aligning interests. It's about setting a tone that reverberates across the entire organization. It makes you wonder, in the coming year, will we see more leaders following suit, or will we witness growing skepticism from investors about such moves? Only time will tell. But history has shown that decisive leadership coupled with bold financial gestures can inspire confidence among both retail and institutional investors.
Before we wrap up, I'd like to shine a spotlight on a couple of the lighter moments amidst our serious discussion. Sometimes I ask myself, when did we ever have such small percentage gains across major indices and still manage to keep the market's pulse racing? It's almost as if the entirety of market sentiment is riding on the confidence and strategic moves of central bankers and CEOs who dare to bet big, while the rest of us are left connecting the dots as a mixture of cautious optimism and, yes, even a bit of humor. And let's be honest, humor is a necessary sidekick in these turbulent times. After all, if we can't laugh at the uncertainties of a global economy, then what can we laugh at?
Now, as we reach the conclusion of today's briefing, let's recap the key takeaways. We started with the latest market data, modest gains across the S&P 500, the Dow Jones, Nasdaq, and Russell 2000, along with positive movements in the cryptocurrency market. We then delved into major trends that reveal how the Federal Reserve is poised to maintain current interest rates for now, even as whispers of potential bad news cuts loom on the horizon. We explored the implications of a sudden spike and subsequent slide in the so-called fear gauge, highlighting the ever-present volatility in today's markets, and we examined how significant leadership moves, such as Intel's new CEO investing $25 million in his own company, send powerful signals to investors about strategic alignment.
On top of that, we touched on the transformative shifts in the technology sphere, particularly with Netflix's rise in the streaming wars and its innovative advertising strategy, which could redefine the very notion of how media companies generate revenue. In our sector analysis, we linked these technological advancements with developments in finance and energy, painting a picture of an economy where every move and countermove is intimately connected to global trends. And of course, we addressed the broader global market implications, reminding ourselves that nothing truly happens in isolation in today's hyper-connected world.
So, as you mull over these updates and consider your own strategies going forward, here are a few questions for thought. What will be the ripple effects on your portfolio if the Fed decides to pivot unexpectedly in the coming months? In an environment where both traditional financial instruments and digital currencies display modest but steady gains, is now the time to recalibrate your risk exposure. And how will bold leadership decisions in the tech sector, such as those by Intel and Netflix, reshape your perspective on the future of everyday investing?
These are the kinds of questions that not only keep us on our toes, but also remind us that savvy investing is not about knowing every answer, but about always asking the right questions. It's our hope that today's discussion provides you with some food for thought as you navigate these exciting yet unpredictable times.
A big shout out to Pantheon AI, your information co-pilot through these twists and turns in the market maze. Our goal is to make complex economic data and corporate headlines accessible and, dare I say, even enjoyable. After all, every investor deserves a briefing that feels like a friendly conversation with a well-informed colleague rather than a monotonous recitation of numbers and press releases.
As we wrap up today's episode of the PAI Morning Briefing, remember to come back for the next episode tomorrow. And if you ever find yourself with a burning question about market dynamics, trading tips, or broader economic trends, don't hesitate to ask our AI co-pilot. We're here to help you navigate this exciting yet challenging landscape. Keep those questions coming, and let's continue exploring this ever-evolving financial world together.
Before I sign off, let me leave you with one final thought. Learning shouldn't feel like a full-time job. Whether you're tracking the latest Fed policy shifts, marveling at technological innovations in streaming, or contemplating the global ripple effects of your next investment, take a moment to appreciate the process. After all, in this intricate dance of markets, a little humor, a dash of curiosity, and a mindset geared toward long-term growth can make all the difference.
This is your host from Pantheon AI, signing off. Stay curious, stay engaged, and until next time, happy investing.